So, what is the fund about? What is the basic philosophy? And how and what is the investment objective of the fund? And then I think we can make it a lot more interactive session. And the most important, and I do believe that the macro time has come back. So, a little bit of your thesis on macro and what is the current macro setup which you are seeing in the global markets.
Okay. Thank you. Thank you, everybody. It's late evening in India and for accommodating my early morning time. Uh, so let's jump directly into what Pinetree does. I'm purely a macro guy. What is a macro thing? Very clearly a 36,000 feet view. Nothing more than that. I'm not a bottom-up stock picker. Earlier, you are used to having people who are bottom-up stock picker who are so passionate about stocks. So think of me as if EPS into PE is equal to a stock price. I spend 1% of my time on EPS and 99% of my time on whether the PE multiple will expand or contract. A P multiple expansion or a contraction is a function of liquidity. So we invest in asset class and not individual securities. We pick asset class based on our view of liquidity. So just to give you an example, Vanguard did a study of last 50 years, and Vanguard study itself says we have that study on our website if anybody wants to have a look. Its study says that 70% of investors' return can be attributed to investing in right asset class, and that for that you have to have a basic understanding of macro regimes. We have also put a study on what kind of macro regimes are there in the world. There are four. We can put it in four macro regimes: disinflationary boom, deflationary boom, inflationary boom, and inflationary bust. We are currently invested as per inflationary boom, and I can keep on talking about it a little bit later. But to be simply, what is inflationary boom? Inflationary boom means investing in assets which do well when government targets nominal GDP and not real GDP. Now, the best way of expressing your view as a macro investor is only in US markets as of now. Why US markets only? There are 2000 listed ETF in United States. Out of 2000 listed ETF, there are 500 of them are very, very liquid. So think of anything, any theme under the surface, any theme, just think of anything. There is a 99% chance that you will be having an underlying ETF representing that particular asset class. That asset class can be commodity, it can be REIT, it can be fixed income, it can be a country ETF, it can be a sectoral ETF. So you just have to think, you have to just ask me, ask me anything. Okay, is there an ETF related to that? And I can tell you 9 out of 10 times there would be an ETF. It might or might not be liquid, but yes, there would be an ETF related to that. Now, something about macro regimes. Now, I want to take you to a history because I have put that history on my website that we got our first bubble. We got our first bubble in 1987 when, Nikkei was around 40,000. We just saw Nikkei in 2023 also. Uh, After 1971, when Nixon closed the gold window, central bankers went berserk. They went on money printing, means the power of money printing came in their hand. It was not backed by gold at all because and before that it was backed by gold. So before 1971 you never used to have these bubbles, although you used to have boom and bust, but you never used to have bubbles. You started having bubbles after 1971 when Nixon closed the gold window. 1987 to 1989, if you know about what happened. By 1988, the Imperial Palace of Japan was valued more than the entire Manhattan real estate. Japan was in a bubble. Japan burst, the bubble burst, but we did not allow the bubble burst to allow to banks to fail or countries to fail. Alan Greenspan pushed a lot of money into the system. He just printed a lot of money. That money went into, after that bubble burst, it created a new high in some other asset classes. 1997, another bubble burst, which was long-term capital management. I'm sure you would have heard of long-term capital management. The long-term capital management bubble burst, and by 2000, you had a tech boom, which is kind of what you are seeing today. 2000, the tech boom bubble burst. You had an emerging market and a gold boom for 2000 to 2008. 2008-9 Lehman crash, US housing crash, the bubble burst, but you did not allow the economy a time to recover on its normal boom and bust cycle. You again pushed a lot of money into the system. You had a gold rally starting in 2013, and on top of that thing, you had this time the money moved into US mega cap tech. 2013 to 2022, you had a US mega cap tech bubble. 2013 US GDP as a percentage of total GDP, global GDP was 28-29%. 2013 US market cap as a percentage of total market cap, global market cap was 30%. So almost same. By 2025, US GDP as a percentage of global GDP is only 25%, but US market cap as a percentage of total market cap is between 65 and 68%. So when 2000 money went lock, stock, and barrel into US stocks, we believe that US stock bubble has burst. Actually, I thought, and I had written that the bubble burst in 2022. Then we had an open AI. Open AI led to the AI bubble, which gave a lease of life of this bubble for 2 years. And we believe this bubble has burst. How can I say the bubble has burst? Over the last 6 months, you have seen that US mega cap tech has not gone anywhere, but the money is leaking out of US mega cap tech on an everyday basis and moving into some other parts of the world. I will go separately into when we have a Q&A why it is happening. But think about it. In 1989, Japan was 18% of global GDP, but 48% of global market cap. Over the next 30 years, Japan GDP and Japan market cap became equal. Today, US is 25% of global GDP, but 65% of global market cap. What can happen over the next few years if some part of this money were to leave US for some other assets, some other countries, anywhere else? So just think about it. So we are going into that particular inflationary boom where we believe that we are moving from a deflationary boom where the money was in few mega cap tech stocks. And in India, every second fund is NASDAQ related fund. Globally, 401ks are invested 38% only in five stocks. And this bubble is seeing a slow bubble burst in front of our eyes. Money has not even started moving out as yet, I believe. Because when I talk to people in New York, people have absolutely no idea. They don't want to discuss that. So we are in a new regime, and this regime, in my view, can last for few years. So this is where we are clearly. So I'm the one who's actually moving beyond this particular. I look at the macro picture, what the governments are trying to do, and based on that, I take my investing call. So this is the investing call which I have is over the next few years, we will create massive winners across the world. Possibly it could be India also, possibly. Because I never look at India, I look at emerging markets. And this money will be leaking out of US mega cap tech, creating winners outside the world. So this is exactly how I think. Obviously, I can add a layer of what President Trump is trying to do, but I'm pretty sure that will come in Q&A. If you want me to take you with some examples, I can take you through some examples of when we bought something, why did we buy it? When we sold something, why did we sell it? I have created that hits and misses also when we did 3 years of our, the fund was, when we completed 3 years of our fund. So I can do that also if you want.
No, I think Ritesh, we can continue with some examples also.
Yeah.
Also, I think in Q&A, uh, uh, we would also like to understand that, okay, do you also create some hedges or put
I will take,
option, and what
yeah. Okay.
and what is the overall objective? What are you guided with that? Okay, what is the objective of my fund, and what am I doing here? We got to know that yes, you take the macro picture, then put your bets across the asset class, and you don't
Hmm.
go through the bottom up individual stocks, but you buy
Hmm.
the overall asset class percent. There are so many ETFs around US and other markets as well, and so you primarily play through ETFs.
Hmm.
So some of the past examples, and I think your last 3 years return, guys, have been close to 19 odd percent after post fees and expenses in dollar terms. So for India, I would say that it is relatively like a 24 or 25% INR returns, and with a much lower drawdowns, I believe. So Ritesh, just a bit of your again
Yeah. So I was just
objectives
trying to
and,
open
and
that.
some of that fact.
Yeah, I was going to open that file. Jay, can you? I'm not able to open that file. I just want to take you through examples so that you have
Um,
a very clear idea of what I'm doing.
so can you try now? I just made you co-host. So
Mm. Can you do it, Jay?
yeah, just give me a second. I'll just open it.
I was just looking at it. I think we've completed 3.5 years. The first guy would have seen his NAV doubled. Uh, and this is after expenses without performance fees. And I just want to tell over here, I have never invested in any mega cap tech stocks or any tech anywhere in the world because there are enough themes out over there. So we just take you through some of our hits and misses just for you to understand our thinking process because macro is not understood properly. Forget India, even globally also. The best guys in just go to the first hits and misses. Just go to the first hit. Just go down. Yeah. Can you open the full screen?
Uh,
Yeah,
give
this
me
is good enough. I think.
yeah.
Can everybody look at it? Okay. So this has been our best call till date. We put a entry. At what point did we enter it, and we are still holding it? It was a very simple call that US sanctioned Russia's FX reserves. When you, it has never happened in the history that a country's FX reserves have been sanctioned. And think about it, Russia's FX reserves are not lying in Russia; they were lying in US because it's in US dollar. And overnight, the Russia's FX reserves are sanctioned. That day, the rule-based order was broken. Actually, that was the day that, where everybody realized that our foreign exchange reserves are not, safe in US. And that is the day that you had a flight of safety starting in gold. So it was a very simple rationale. And that rationale has continued till date. Our top holding has been GLD ETF since the inception. So just wanted to put over here, what was the entry rationale? What was the rationale for holding? What was our view when we bought it? So that you can have a fairly good idea of. So gold, I don't need to tell gold to anybody now. But at that point of time, it was a concept which was not known. So possibly we bought at whatever price we bought it. And today you've seen where it has gone through the roof. So it has given us a good alpha. We continue to hold it. Obviously, last month when it went parabolic, we reduced our holding a little bit. But to buy it back whenever euphoria dies down, I still believe that US dollar status as the reserve currency is going to diminish over the years, and gold will come back to the monetary system as a neutral reserve asset for the simple reason it is a responsibility of the reserve currency to run rule-based order, to pull a shipping line across the world, to run current account deficit so that its currency can be internationalized and can be used for international transaction. Under President Trump, they do not want to do any of these things. So till the time you have the next reserve currency, or maybe US bounce back, gold will continue to act as a neutral reserve asset. So it's a simple thought process. That's why gold will continue to be one of our top holdings. Next. Jay, next. Hmm. This is where just want to give you because I am a currency guy also. I started my career and I have done cross currency trading also. Japan, I'm pretty sure a lot of people would have invested in Nippon India Japan Fund. But what we found was that yes, Japan is trying to inflate away the debt. If Japan is trying to inflate away the debt, it is very good for equities, but even their currency will fall. There is only one currency hedged ETF in the world, which is Japan Currency Hedged ETF. We not only bought Japanese equity, we bought currency hedge Japan ETF when dollar JPY was 130. At 160 on dollar JPY, when we had made kind of 40% return kind of thing, we exited the currency hedge Japan ETF and went into non-currency hedge Japan ETF because Japanese currency had become very cheap. So it was a call on both currency as well as the equity. And you have this document on my website, but I'm pretty sure team will find it very interesting just to go through this thought process. So we'll share it with you. Next. Okay, somebody asked me, I think DJ, you asked me about the hedging part. We hedge through bond. So the way you know VIX, everybody know VIX, right? VIX is equity volatility. There is an instrument for bond also, bond volatility ETF, created by a guy whose Move Index, if you know of, Move Index was created. The creator of Move Index created this ETF, PFIX. If you believe the bond volatility will rise, then you should buy this thing. So we bought this thing, and then you know what Liz Truss movement happened in UK. UK bond went bigless. We had bought it around an entry point, and the exit point, exit point is in red over there. I've just picked it up again because I believe they're going to mess it up again on the bond side. So we picked up a small position in bond volatility. So if you're asking hedging, my hedging is not coming through normal instrument. It is coming through instruments like PFIX. Next, Argentina. As soon as President Milei was inaugurated, I realized this is something different. We took a little bit time, but we bought Argentina because people have never made money in Argentina. Argentina is continues to default three. They defaulted 3 times in the last 30 years. So it's a leap of faith for you to do it. So we picked up a small position in Argentina and we still continue to hold it because I believe LATAM will deliver outsized return compared to any other geography in the world. The kind of economic reforms which are happening in Chile, Brazil, Argentina is mind-boggling. And there are no more leftists. Rightists are coming over there. So I believe it is very good. We do have Argentina and Brazil ETF in our portfolio. Again, we have taken a call on Brazil Real, Argentina Peso, as well as this. Yeah, next one. Yeah, when everybody was going for US mega cap tech, we bought China Tech. And China Tech has, not many people know, China Tech has beaten US Tech. I took a call on CNY also, that Chinese yuan will appreciate. And I took a call on Chinese stocks also. They've started buying back their stock and Chinese currency has started appreciating. So this is a part of our portfolio. Again, this did well. Not mind-boggling return, but this did well. Next. Jumia. So I wanted to give an example of an individual stock also. 9 out of 10 times you will find an ETF, but there is that one time you might not find an ETF. As per the offer document, we have minimum 80% has to be invested in ETF, but up to 20% I can go into stocks where I cannot find an ETF. I'm very, very bullish on Africa over the next few years. But there is no way to play Africa ETF. There is an AFK Africa ETF, but which is mostly in South Africa. Jumia Technologies is Amazon of Africa. It is available in 10 to 12 countries. Jumia Technologies ADR is listed in United States and it is regulated by SEC, owned by Rocket Internet out of Germany. We bought it around $3.50. It took some time. I just buy ahead of time. But we never buy it some things which is very liquid, we never buy it more than a very small percentage. So here is the position sizing. In spite of having a very big view, we only bought 1% of the portfolio. It has quadrupled in the last 2 years. And we continue to hold it because I'm very bullish on Africa. So I do not trade these things. Next. This is where I want to show you our misses. This is where we lost money. This is the lithium ETF. And you have the entry point, you have the exit point. Wrong call. There are some losses which have to, you just take your losses, move on. But again, I bought lithium ETF in November, December. I exit completely whenever the view is not working out, get out, reassess it, and then come back again if you believe in it. Next.
So one question.
Yeah.
So, what are the defensive anchors in the portfolio? Given that you chase a lot of liquidity, how do we make sure that in the event that the liquidity, sometimes there's a delay in what we anticipate or what we are seeing. So, what gives your portfolio, that defensive tilt?
Okay, so let me first finish this thing and then I will answer that question. Okay, there are just two more because you've seen how, I had shown you more of where we did well. I want to show you equally of where we did poorly. Okay, so this is just amplify AI powered ETF. I thought since AI was coming, there would be AI will be able to pick up good stocks. I entered it, exited at a loss, and now it is putting an all-time high, but we never went back for it. Again, a loss over here. Next one. Vietnam, I did not have the patience to hold. The call was right, but I realized that I am the only one who's understanding this thing. Why is others are not interested? I exited it, and you've seen what has happened to Vietnam. Next, this is let's just say this is one instrument which we do it for volatility purposes. And this is one of the hedge in the portfolio. Even currently, I have a hedge in this portfolio because the world is becoming more volatile. I need to have some hedge in the portfolio. So when you have people when you have something like VXX or you have something like PFIX or you have short junk bonds, that gives you some kind of stability to the portfolio. So this is not to make money. You never make money on hedges. That actually you should lose money on hedges so that you make money on the portfolio. So this is a necessary cost of doing the businesses. So here there's a time decay. We keep on losing money, but we still hold it in our portfolio. That's I think done with this. Jay,
Yeah, we're done. We're done.
just take out the screen, please.
Yeah.
So Shivesh, uh, what you have asked is what gives the stability of the portfolio. I will only share with you some data that which actually one of the clients did it himself because he wanted to put money. We participate on the 60% on the downside and we participate 90% on the upside of compared to the benchmarks. Now, I'll give you again a great example. For the month of January, uh, our portfolio delivered almost 9.5% return in spite of all the carnage you saw on Friday. Because once we have made money, then I actually become a risk manager. It is not that I'm holding to a particular asset. But if you are asking me that, can you put it in an Excel and show me that how you are going to do it? No, I cannot put it. I cannot put it. Somebody who's holding 35 to 40% in commodity has to be volatile. For delivering this kind of return, you have to go outside the basic tenets of investing in only US mega cap tech and going into assets which are undiscovered, which are unloved, which are ahead of time. And it means having patience to hold on to them and waiting for them to play out. Some of them don't play out. And I never buy assets when I'm into losses. I always add to my assets when I'm confident and when the asset is already in the money. I buy a new assets which is roughly, let's say, just 1% of the portfolio and slowly build it up to 2, 3, 4% of the portfolio. There are only five assets which are above 5% of the portfolio. That tells you the depth of the portfolio.
And how many underlyings would be there, Ritesh, in the portfolio
There would be
on
30
general?
portfolio. There would be 30. So if you're putting an ETF, an ETF itself is having, if it is not a commodity ETF, it itself is having 25, 30, 30 securities. So stocks are moving these days, haywire, like 15, 20% movements are happening in stocks. Whenever you're having an ETF and an ETF constructed in such a way that an individual stocks are not more than 8 to 10% of the portfolio, to that extent, the volatility of the portfolio itself is lower. But if it is commodity, if it is gold, if it is silver, like what happened on Friday, it will be volatile. So give you an example, just between in this call, that we were down 3% for Friday alone. And that was once in a, in 10,000 years event, what would have happened on gold and silver. And that is what was the loss. So we were up 13% or 14% and we closed at 9.5% for the month.
Ritesh, since we, I mean, your website also says this, and you also said it today, that we are chasing global liquidity. What
Yeah,
exactly do we mean by when we are saying liquidity? Is this portfolio flows? Is it government flows? Is it central bank flows? What are you really tracking when you say liquidity?
it is central bankers' balance sheet. Cross-border capital comes out with a data. They have a data of 70 central bankers. So the guy who's like the god of liquidity is cross-border capital. They've done a lot of work. We subscribe to their work also. They calculate the liquidity on a weekly basis for 70 central bankers put together. And that is what we keep in mind whenever we are, talking about liquidity in. So you can look at some of their work, read some of their thing. I did not have to reinvent the wheel for that thing. If I can pay and get some work on that thing, and my job is, okay, the liquidity is expanding. Where is that liquidity going? That is my job. If it is expanding, if it is not expanding, then we have a separate problem altogether. But that problem is much bigger than losses in our portfolio.
And also, since you mentioned that within the month of January, you had probably your greatest month since the fund went live.
Yeah.
But last Friday was probably the worst day also ever in the fund, right?
Yes.
Uh,
Yes, it would be. Yes.
so, given that parlance, what should investors expect in terms of, let's say, standard deviation, or in terms of drawdowns, or what has happened in the past and what can they naturally expect in the future? Let's say on a month-on-month basis, when they're looking at their NAVs at the end of the month, what's been in the past and what should they expect?
Sorry, Anuj. I do not do on month basis at all. I have no understanding of any month on month. What we can share with you is standard deviation. But there are themes which will play out over a period of time. These are not stocks. These are undiscovered stories, some of it, and it could take time. But due to democratization of information, everybody gets to know the story at the same point of time and reprices the asset overnight. That democratization has done to our markets, to global markets. So either you are invested before that thing, because on that day, when it is everybody knows about it, you cannot buy it. So you will have a part of the portfolio which will be ahead of time, positioned for it, and waiting for others to discover. Now, I cannot talk about month on month. Yes, it will be a volatile portfolio because I will not constrain myself to a particular sector. Although individual securities will never be more than 10% of the portfolio, I will not constrain myself to अरे तुम्हारे पास commodity 50% क्यों है, although it is 35%, commodity 50% क्यों है. So I will go by what I think is right. My job is to make sure that over a period of time that the NAVs do not get out of line. April 2025 was the month where taco trade was born. Why it was born? Because in those 4 days, markets collapsed in US because of trade and tariff war and all those. During that point of time, again, we were down only 3%. That was the worst month for us, 3% when everything was down. January, where we know it's a once in a 10,000 years event what happened in gold and silver. And if gold and silver are 15% of your portfolio, and for the whole
Yeah,
month you are up 9% for the month, it's not only gold and silver which are giving me return. There are other assets on the portfolio which are giving me kind of balancing it. And it is my responsibility that I have to become a risk manager. I just wrote it on Twitter that there are times where you have to play like Sehwag and there are times you have to play like Rahul Dravid. Last week was when we were playing like Rahul Dravid. Now I cannot put it on Excel. I'm only doing it through my years of experience that there are times when you have to play like Rahul Dravid.
fair
You
point.
just have to add a risk. You have to just cut risk. You have to add cash. You have to continue adding that thing. You have to allow some things to move out away from you. It is okay. It is okay. You cannot get everything right.
Fair enough.
And there
Uh,
are, unlike India, where you are only one market, there are enough bull markets over there. We've never invested in tech. We've beaten all the benchmarks in the world handsomely, hands down, without investing ever in US mega cap tech. I always look at second and third derivative. I never looked at tech. I looked at electrification. I looked at US industrials. I looked at US, infrastructure. So I always not look at what is available, what you can see it in front of your eyes. Like that, everybody knows. You don't make money in that. That is repriced very, very fast. You have to look at the second and the third derivative. And it takes time for people to catch on to that. And there are times you will be wrong. There are times you'll be wrong. That's okay. You can be wrong on a smaller part of the portfolio. You cannot be wrong on the big part of the portfolio.
Ritesh, I think I read that in one of your example slides that you've invested maybe only in two stocks till date, and you took the
Yeah.
example of one. If you don't mind me asking, which was the other?
Sprott investments. Sprott investments is the biggest issuer of real assets ETF in the world. The way BlackRock is for financial assets, Sprott investments is for real assets. It has doubled in the last 6 months. Money is moving from if my view is that money is moving from financial assets to real assets, then the simple trade is short BlackRock and long Sprott. We don't short, but we can go long. So uranium ETF, Sprott uranium ETF, uranium miners ETF, gold, silver, all these ETFs. The issuer is if the money is going to move from one asset to another asset, the issuer who's there, exchange always make money. Remember that thing. If the volumes rises, the exchange will make money. There's
Yeah.
a simple example. So that is why it's a part of our portfolio. It will remain a part of our portfolio till the time my view of real assets over financial assets hold.
Hi,
Thank you.
Ritesh, Mohit here.
Yeah.
Ritesh, what is your allocation country-wise? Means to Southeast Asia, yeah, to America, yeah, to Europe, yeah, something. What is your allocation you have maintained in the current portfolio?
That we can share with you as a percentage. What we give it out is only US commodities and non-US. US is
Acha,
25 to 30%, commodities is between 35 to 40%, and another 30% is rest of the world, which includes LATAM, which includes LATAM. I've taken Turkey over there. China is part of that 30%.
and in commodity, in what all commodity you participate? Only gold or silver, yeah, in
No,
copper.
gold, silver, uranium, copper, oil, natural gas, lithium.
Okay,
I have
okay,
all of them are part of my portfolio. We started
okay,
reducing gold, silver last month to add oil and natural gas to our portfolio. Copper has been there for some time.
got it, got it. Sounds
Uh,
good. Thanks,
Hi,
Ritesh.
Ritesh.
Thanks.
Yeah. Hi, Ritesh. So, as you said, you have basically transferred your position from a hedged JPY ETF to an
Hmm.
unhedged one, right?
Yes,
So
yes,
that means your view on JPY is no more bearish. You feel that
yes,
they will start maybe it settles down or maybe it appreciates, right? So
yes.
with the current yields going up in Japan and
Hmm.
currency appreciating, doesn't that unravel the carry trade that people were enjoying? And doesn't that also pose a risk of Japanese starting to reinvest in their own financial markets?
So Japanese, it should have been done by now. Till the time J- Japanese repatriate the capital back from rest of the world, they own 5% of Australian bond market. They're the biggest investor in rest of the world. Till the time they start repatriating their capital from rest of the world to buy their own JGBs, the carry trade will not unravel. It should have unraveled, but they're not investing it back. They're okay with investing globally. So I'm okay holding it. And that is why I believe that Japanese yen has actually not depreciating. It might not appreciate, but there is no more depreciation benefit in my view by holding a short JPY position. But carry trade has not unraveled till now, although for the last 1 year, the bond yields have risen 100 basis point in Japan, but Japanese pension fund, Japanese large institutions are not selling global assets to buy JGBs, and this has happened for the first time.
Sure. Okay. Thank you.
Hi, Ritesh. Good
Hi.
morning. Uh, so, if my understanding, based on what I've heard today and what I've heard over a period of time on your regular podcast and YouTube channels, Now, what you're saying is that right now there's a movement of capital from US markets to other asset classes and other market, which includes commodities, which also includes emerging markets and emerging economies. But then commodity, besides gold and silver, other commodities are more industrial commodities. So, do you see any kind of movement in those commodities as well, or only restricting it to like lithium? I understand is because of the EV vehicle, because of the RE renewable energy and storage of renewable energy, lithium is required. But besides that, like copper, steel, iron ore, and all those commodities, are you bullish on them as well, or only
Yes.
restricting it to gold and silver?
No, I am
And
bullish on them as well because on one side we are looking at US reindustrialization. On the other hand, in China, we are looking at anti-involution.
right,
And I think for the first time, they are very serious about anti-involution. They are
uh,
cutting capacities exactly at the time US want to industrialize.
okay,
So I
so.
am bullish the entire ecosystem of industrial commodities, but
Mhm.
there are only few industrial commodities in which you can invest.
Because China
That's
has been the
the thing.
biggest consumer of commodities, like they have been the biggest industry in the world, and they have been the biggest consumers. Now, if they are slowing down and US industrialize at the same pace at which China is slowing down, then it would sustain. But if it doesn't happen, then
So China is cutting down capacities. It's yes, it is reducing consumption, but it is cutting down capacities. It is cutting down that competition which was there. That is the new word out of China, anti-involution. Talk to
okay,
industrialists in India. They are actually saying, yes, US, China for the first time is cutting down capacity. China gave deflation to us from 2010 to 2020s. China will give us inflation for rest of the 5 years.
okay, and this will be a commodity-based inflation.
Sorry, there is.
It'll be a commodity-based inflation.
It will be a commodity-based inflation. I will be positive on global liquidity till the time oil prices does not rise. The day oil prices rise to 80, $85, I have to become much, much more cautious.
Okay, and on the tech side, you are not very bullish on the AI space, where that so much of evolution is happening and so
No,
much of
no, no.
invention
I
happening.
never said that thing. If Google search query takes whatever, okay, Google AI query takes 25 times more computing power than the normal Google search, what should I be bullish on? I should be bullish on electrification. When Jensen Huang now says that our problem is not chips, our problem is electricity.
Yeah.
I have grid. I am playing in the second and third derivatives. I don't have any understanding of, I do not have better understanding of Nvidia, Microsoft, or Apple. With some of my friends in New York, they live, eat, breathe, sleep only the tech stocks. I
Right.
don't have any advantage over them. The advantage over them I have is I'm able to look at the second and the third derivative. I invest over there. I believe in picks and shovels. More money is made in picks and shovels. I do not know which model will be successful. All of them are competing with the model, but all of them will spend money to make their model successful. Till the time that money continues to spend, you will have electricity doing well. On top of that thing, Western world was low energy usage economy because of service sector. Now Western world, Europe and US both want to industrialize. They want to be high energy usage economy. Electricity, infrastructure. So if I have to invest in US, 30% of my portfolio is in US because US is 25 to 30% of global GDP. That 30% has to be in the sectors where the government wants to invest money.
Fair enough. And in the current scenario, geopolitical scenario, where there's so many wars are erupting across the globe, the defense is a key focus,
Yes.
and now everybody want to be self-sustainable. So, do you have any defense stocks also in your portfolio? Do you have some allocation towards the sector?
Yeah. So I used to have the US ETF, ITA. I believe now, and we played it a lot. I've moved from that to World Defense ETF. There is Wisdom Tree has started Asia Defense ETF, Global Defense ETF. We have invested in a Global Defense ETF where you have companies from UK, France, Germany, even 4% allocation to India. But that is not liquid enough for me to make it a very big position. They've not got the AUM as yet. I will not go to individual stocks. My understanding is not there of individual defense stock at all.
Fair enough. So there also you have taken an exposure in defense
Yeah,
side.
we have Wisdom Tree Global Defense ETF.
Fair enough. And what are the things besides Japanese buying their JGBs back and US not industrialize at the pace which we are expecting it to industrialize? What are the
Mhm.
other things which can go wrong in the market where you can see another burst sooner than
Yeah,
expected?
only two things. Either oil prices rise, the world is so indebted that we cannot take even 85, $90 on oil prices. We will go from rate cutting to rate hiking overnight if the oil prices go. Second, global bond yields are breaking out. The more bond yields rise in an indebted world, the very bad it is. Australia yesterday raised the rate. Not many people know about it. Their inflation went out of hand. They raised the rate. The first country in the Western world outside of Japan to raise the rates. So my worry is that can inflation come back faster? If inflation comes back faster, the kind of liquidity which we are seeing in the system will be constrained, and you will have a collateral damage across every asset. Every asset. Fixed income, equities, even commodities will get hit because market will start pricing rate hikes instead of rate cuts. So these two things make me nervous. Today if you see US bond yields are breaking out. It's 429 on 10 year. At 460 to 470 on 10 year, I can assure you US markets will be 10 to 15% down if that level breaches. So I'm taking that thing into account when I'm investing. All these things, everything is interconnected. And you cannot just look at one thing and make a call. You have to look at everything in totality and saying what can break over here. Look, I'm already up now 10% year to date, including today. I can just close my books and it will be happy.
And
But every day is a new day, unfortunately, in our business.
right, that's fair. So are the US interest rates or the global interest rates going up, which I don't think is a very favorite political choice right now. Like every prime minister and president want to keep the interest rates in the check. They are changing their governor in US to bring their interest rates down. So I hope that would not happen soon.
No, no, that's a wrong thing actually. A central banker can influence only the short-term rates
Right.
up to 2 years. Huh? A central banker cannot influence the long-term rate unless they specifically do yield curve control. So I can assure you if 10-year bond yield crosses 460 to 470 in US, you will have a yield curve control in US explicitly, and gold that day will rise another $1,000. Then it can fall $1,000 in a day.
So you're saying that if the yield curve goes out of whack and it crosses 460 on 10, that's the
460,
time.
470, 75 on 10
S-
year,
So
they will
that
do
time is the time.
explicit yield curve control.
So that is the time when you can actually top up on the gold as an asset class.
Now I will top up above 5,000 back. I'm a student of history.
No, no, I'm saying
Whole
that time
numbers.
shift assets from other assets, shift money
Yeah,
from
yeah,
other
yeah.
assets to gold, right?
So let me give you a small example, and you can arrive at that conclusion yourself. You don't need me for
Right,
that. 10 to 15% of US tax collection is through capital gains.
right.
They are running 7% fiscal deficit. If bond yields rise, you agree with me that US equity markets will fall
Yeah,
anywhere in the world, correct?
yeah,
If US equity markets fall, their tax collection, their capital gains collection goes down to zero.
yeah.
The fiscal deficit goes from 7% to 9, 10,
Seven.
11%.
Mm-hmm.
Think about what will happen to US economy. California, 20% of tax collection is through ESOPs.
Fair enough.
If California was an economy, it is the fifth largest economy in the world.
Mm-hmm. And all on the ESOPs.
It's a matter of national security in US that bond yields don't rise, equities don't fall for extended period of time. If equities fall for extended period of time, then gold will not be 6, 7,000, it will be $10,000.
So coming
Because
back
then you'll have to
to
print more money. You'll have to print more money
which will
just
further
to get
push the
that back.
inflation up.
Sorry?
If you'll print more money, you'll bring in inflation further, and you have to further hike the interest rates to bring it
What?
down. So it's like a
What?
cycle.
Perfect. 1929, 1930, Great Depression, they did not print money, central banker did not exist. What will politicians prefer? 7-8% inflation or bread lines?
I think 7-8% inflation.
Absolutely. Even in India, we cannot have bread lines, right? An emerging country, forget about the Western world, right?
Yeah, fair
Donald
enough.
Trump will lose the election that day itself.
Yeah,
He's a politician.
fair enough.
My view has no meaning. I have to look from what will they think, what will they do.
Fair enough. Uh, so you're saying that the interest rates can actually play a devil in this particular story right now, and which you
Interest
don't
rate and
think
oil.
and
Interest
oil.
rate.
Fair enough. Thank you. Thank you so much.
Shrikant, you
We
have any question?
have
Yeah,
about
if
10
no one
15
else
minutes.
has, I just wanted Ritesh, firstly, thank you. It's always good to hear you. Always been very lucid and clear. But one guidance, if you can give all our colleagues, look, and you know India, so people are very trigger happy in India, right? They come in, they go. Some questions were also on month return. So I also want us to caution investors in terms of uh, it's a macro theme. Cycles are shortening, but still macro themes are far longer than bottom up approaches. You don't have monthly outcomes. If you have it, you're at best lucky, but you don't play for those monthly outcomes. So if I invest in a product like this, I invest with a feeling of perpetuity that this is something that I'm comfortable with. I like this. I just want to hear from you also, Ritesh, and also guide everyone that what kind of investors would you fret because sometimes wrong investors with wrong expectation coming into a fund
Hmm.
and not too many macro managers are in India, and as you know, so it's a very while everybody loves to talk macro, but we don't have too many macro managers in India. So, how would we position it to investors in terms of looking at it from time horizon? For me, as I said, individually, I like it to even look at it as perpetuity. If I should just be, I'll actually let it be and not worry about timing it or any such thing. What would you say in today's day and age when even though the macro cycles are shortening as compared to previous history, but still, what is the absolute red line that people should keep in mind before guiding investors into this?
So, Shrikant, here I must tell you about the macro investing. The industry has died. The last big guys of macro investor left the industry simply because they say यार लोगों को समझ में नहीं आता है. They went back and started managing their family money, starting with Stanley Druckenmiller, who's the big guy, or John Paulson, who made money in gold, or Kirill Sokolov, who started 13D. Honestly, my generation, there are not macro investors. Uh, so, and one more thing, if we were a hedge fund if we were a hedge fund in Bloomberg ranking, we would have been top 10 percentile in the world in the last 3 years. Now, the problem I face with taking outside investors is that that's the only reason we have reverse solicitation. Anybody who's read my thoughts over a period of time is the only person who writes to me saying, I want to invest with you. Since he's read my thoughts, he has basic understanding of macro investing, what I look at. So till now, I have not found investors who fretted at month over month returns. Simply because they have a basic understanding. So you cannot sell macro investing to somebody who does not have basic understanding of this. That's why we don't have distributors. Because I do not want to break my head explaining what has gone wrong for this particular month because it's not a linear return. Actually, the linear return is not there even in micro investing also. But at least over there you can talk a particular stock to somebody. Okay, नहीं सर इसका रिटर्न आ जाएगा इसका क्वार्टरली रिटर्न. Macro is not like that. It takes the cycle can be longer also. The cycle can be shorter. But my problem is simply that I cannot explain that this can be a month over month product. If you give me a 3 years time horizon, I can assure you that I have a very clear thought process where the markets are headed. But in the meantime, you saw what happened on gold on Friday. If we would have not cut our risk in the last 15 days, we would have given back the return. But, and then thankfully, we added on Monday morning back. Thankfully. I would say thankfully. So I'm just saying that you need to be aware that This can be volatile, but these days my product is no more volatile than a bottom-up stock picking, a portfolio. It's no more volatile actually, month over month if you look at it. But I would not sell this thing to somebody who doesn't understand macro investing and who's not read
Yeah.
macro investing or has not read my thoughts. We don't take, we actively discourage that thing.
No, completely agree. I just wanted everyone to also listen in from you because I think in a product like this, we should let the most of the themes play out and actually let compounding sort of show what magic it can do. So I think uh, most folks who haven't done macro investing need to just, in fact, I would say even before we take the particular fund to investors, every colleague of ours, including me actually, should read the newsletter to be very clear to expect what we are expecting from this because otherwise it ends up becoming a very
Yes, actually, that is right. So we have grown only organic. Like we started with $700,000 of friends and family money. Today we are at $15 million, all direct, no distributor in between. You are the first one with whom we are, collaborating. Actively discouraged every distributor because people were coming based on the past returns. Past returns has no meaning. Past return is not for you. Somebody has taken that past returns. Actually, you are coming to having a confidence that I can deliver the future returns. That's a very big difference.
Yeah, I had a question. Uh,
Yeah.
so you talked about moving money from to real assets. Within that space, where do you look at how do you look at real estate? Because on one side you're saying interest rates are going to rise or are rising, and but real estate obviously very sensitive to interest rates. What's do you have any real REITs or are
No,
you
no, no. I
REITs?
never said real estate. I said real
No,
assets.
you said real assets. So I mean, real estate is a part. I mean, what's your view? That's what I'm asking.
No,
What's
I
your
have
view?
not invested in real estate. I am massively bearish real estate in Western world. As soon as the Western world's love affair with immigration was over, real estate is done in Western world. But this is one asset where I have not built up capability. REITs. I said there are better ways which I understand. I've been looking at for last few years. So I prefer to stay with that. And that is where I have a constraint also that there are some assets which might be doing well and which I might be missing out also. I cannot look at each and everything theme. Yes, I do have an understanding of 50 countries in the world, but I do not have the understanding of another 100 in the world. I would prefer to be with those 50 where there is a very good macro, there is what data outside, there is very good quality of data available. The ETFs are very liquid. I have a call on that currencies also. Like people ask me about Venezuelan Bolivar. Okay, Venezuelan ETF. The first thing is these things are very, very liquid. Venezuelan ETF is very, very liquid. I do not have a Venezuelan Bolivar. I actually bought a Pakistani ETF at one point of time and realized in my personal portfolio, I took a call that yes, the liquidity will come because of IMF money. But you couldn't sell it, even in my personal portfolio. I just took it for the heck of it. Uh, the currency was appreciating at that point of time. So we will not go to the things which are not established, at least at the basic point of minimum, where you have a minimum $100 million. And there are a lot of REITs out over there also which are not having that kind of liquidity. But my understanding on REITs is you can say it's zero.
Sure.
One last question, Ritesh. Since you're talking about currencies, you're talking about the trends which are changing. In the current scenario, the cryptos are becoming
Yeah.
replacement of the global, how the global money moves from one country to another country. So, do you have any outlook on cryptos? And there is an ETF available on cryptos as well.
So
So,
there are a
do you?
lot of ETFs available on cryptos. There are four cryptos on which ETFs are available. Now I find a little bit problem over here because a lot of my clients, family offices are asking a declaration that we will not invest in India ETF or in crypto ETF. They are getting queries from ED in their other investments which they are doing. So we will not invest. It is a part of FAQ in cryptos or in India dedicated ETF. Yes, there is a world global defense ETF in which there is a 5% allocation of India, Cochin Shipyard or some company, but we will not invest in an India dedicated ETF because it is almost like round tripping of the money, or we will not invest in cryptos which BRICS country are frowning upon.
I was talking from a point of view as a asset class. Not okay. I understand you do
No
not want.
understanding. No
Okay, fair
understand.
enough.
I understand stable coins.
Okay.
I understand stable coins. I understand why they are trying to do stable coins. My understanding on cryptos is not at all. Is not there at all.
Is there an ETF available on stablecoin?
No, no.
Not
But
yet.
there is a gold-backed stablecoin just launched by Tether. For the first time, I am looking to buy something for my own wallet. Gold-backed stablecoin.
Fair
I
enough.
will not buy US dollar backed stablecoin, but a gold-backed stablecoin I will buy.
Fair enough. Thank you.
Hi, I
Ritesh,
have
Ritesh,
one
I have a
question. Yeah, Ankit, you
sorry.
can.
Nalin, go ahead.
Okay,
Nalin, go ahead.
you mentioned that you are building position in crude oil and natural gas, right? So,
Hmm.
what is the rationale behind it? What are you looking to be incrementally positive on this side of,
Yeah.
crude and natural gas?
So US oil production was 6 million barrels in 2009. By 2024, their oil production went to 13 million barrels per day oil because of shale. In fact, they created a Saudi Arabia that 8 million barrels was equal to Saudi Arabia's oil production. And that is why the best place to invest in the world was between 2008 to 2023 when US inflation collapsed. The macros were stable, so all the macros guys went out. Now US shale production is actually topping off. US shale is not like a normal reservoir where you can Gawar oil field in Saudi Arabia where you are pumping it for last 60 years. Here, these assets actually drain very, very fast. And I think that is the reason they went into Venezuela also. I believe US shale revolution is coming to an end. If US shale revolution is coming to an end, and oil is the only cheap asset left in my entire commodity book. Okay, nobody wants oil, nobody wants to discuss oil, and I see that drilling rigs are coming down. US shale production is not able to increase. They want to go for offshore drilling. They've just changed Gulf of Mexico to Gulf of US, something that they've done it simply because they understand that their oil production is stopping off. So I needed to add a little bit oil to my portfolio on that thing. Now, natural gas, people talk about if you're looking at electrification, if you're looking at AI, then yes, nuclear power will do well, but it will come in 10 years. It is not coming tomorrow. There is one thing which is abundant, which is natural gas. And that is why I wanted to own a little bit of natural gas equities in my portfolio. They were under owned. There is a climate related impact where weather becomes cold in North America and the prices goes through the roof. I'm I'm not looking at that. And that is why it is only 1% of the portfolio. Natural gas is only 1%. It is so volatile, it moves 40% in a day. Okay, you cannot have anything which is so volatile to be a big part of the portfolio. Actually, these days, gold silver also moves 20% in a day. What can we do about it?
Okay, thank you.
So, Ritesh, you mentioned on
Yeah.
US market cap being 65% of the total market cap.
Hmm.
So in that, also you mentioned that there is an incentive for the US government to not let the markets go down because it impacts the capital gains.
Yeah.
So do you expect that other asset classes will keep on growing or other markets will keep on growing and US doesn't fall much, and it so that's how the returns will culminate in which uh, the US market cap, the proportion comes down due to other markets going up and not because.
So Ankit, you are on mute, but I got your question. It's a very good observation which you've made. If you see, Microsoft is at 2 years low. People don't know about it actually. Till the time you tell them Microsoft is at a 2 year low. It's the same price what it was 2 years back. On the other hand, companies like G Vernova has a seven bagger in the last 1 year. Money is moving, in my view, from NASDAQ, old leaders, to the new leaders, which is industrials, which is Dow Jones. I am not invested in the old leader. I have 26% allocation in US, but I am invested in where US government wants to do. US government is very clear. We want to reindustrialize. People will not take US dollar. They've already seen that what has happened on the rare earth. They cannot make a Tomahawk or a Patriot missile without a rare earth taken it from China. So China will give them rare earth so that the same Patriot missile can be used on China. Americans have understood this thing. Americans are going on the scale of Marshall Plan to reindustrialize US. Now I keep on getting a pushback. Ritesh, they will not be able to reindustrialize. I said, fine, they will not be able to reindustrialize. But will they spend gazillion amount of money to reindustrialize? Money is always made in liquidity. We will come to know 5 years down the line whether they got reindustrialized or not. But that point of time, a company like Geo or a Vernova, already a seven baggers, can go up another double from here. And the name of the company is just for reference purpose. I have no interest. G Vernova is a part of our portfolio, of our ETF. It is not a part of our portfolio.
Right. And Ritesh, in terms of the profit share of the US markets, as in you mentioned the market cap and GDP shares, but do we have some context in the profit share?
Yes, it is 40 to 45%, but most of it, half of it is coming out of US. US companies earning
Got
out
it.
of US. So the
Got it.
profit pool of rest of the world is rising now. Look, mega cap tech is going from buybacks to capex. China and Japan is going from capex to buybacks. What will you buy?
Right. Ch- Chinese stocks.
So there is a question, what is the specific reason why this fund is Cayman domiciled? DJ, you'll be able to take that question offline with the team?
Which one? Which one, Ritesh?
Why this fund is domiciled out of Cayman? There was somebody who put it this over here.
Okay.
So you
No,
can
I
take that
think
through
most of,
separately
I
with the
think,
team.
yeah, yeah. Also, just one thing, Ritesh, on that account, when you do some uh, churn in the portfolio, etc., because if things would have changed or things just played out much earlier than what you would have thought. Yeah. What about the taxation? Is there any taxation part, or we just take it out with Jay? I don't think that probably, if in case you are not very well versed, then we'll take it through Jay. Are there any tax? As far as I know, Cayman funds don't have any tax. It's a it's a tax free jurisdiction.
Yeah,
Uh,
it's a
so
tax-free jurisdiction, Jay. I think this is what we got it from Dovetail also.
Yeah, it's a tax-free jurisdiction, so we give the entire sum of investment amount plus capital gains back, and at the time of redemption, the investor pays
yeah,
as per their tax jurisdiction.
as per
So
their tax,
yeah,
fine.
so Dubai, Singapore will be 0%, India will be 12.5 or
Got it,
20%,
got it.
but it depends
So the
when they
fund,
redeem.
so the fund doesn't hold any taxes. It's not like our India AIF Cat 3 where tax
No.
is discharged by the fund, etc. So it's a जो बना वो पूरा का पूरा चला जाता, कोई capital gains है नहीं वहां पे,
Correct, correct.
Correct.
Obviously, there is an exit load part for 12 months, which you are aware about,
which is
right?
fine. Yeah, yeah,
Yeah.
absolutely, absolutely. No, guys, I think we can continue to have these interesting discussions, and I think Ritesh, any which ways, comes out with his views either through the on. He also runs his own channel in Aratai. Aratai is a local version, like a WhatsApp version from Zoho. So he has stopped using WhatsApp for any of his communication. I have the link. I have already kind of added few of the people in the system, and through that they have also started adding Aratai. Uh, I will put it out on our internal WhatsApp group, uh, and you get a message whatever he is putting it out, uh, and how he's constructing his in that he just doesn't do over marketing of anything. So he just put out the things which he is finding relevant. He's putting out his own Twitter feeds, and on the performance he just comes it out every month that this is my performance of the month. So it's a completely knowledge driven channel which I would request each and everyone at Ionic to definitely join. Of course, you can't put out your query. It is completely controlled with Ritesh only putting it out there. Uh, and second, he's also keeps actively writing on LinkedIn or X. So large part of his views will be available through not just the fact sheet, but also through what he's putting it out there, and that is also a part of his overall thinking and then positioning the portfolios according to the mega trends which he's looking at. Of course, as he also pointed out, that when things change, you got to change as well. You got to play like a like maybe Raghuvanshi or Suryavanshi, whoever is that youngest cricketer who keeps hitting sixes only. But at times you have to also play like a Rahul Dravid, and that's what a matured uh, fund managers you would expect you would expect them to completely claim it and kind of agree with what the trend are. Before we wind up, Ritesh, just the last 5 minutes. Today in India, more discussions, more memes are followed on gold and silver. In fact, your last call when you said that the rise of silver around 100, $120 was your max price, and you kind of reduced your holding, and you were looking at that a 20-25% cut. If it comes here, it is more healthier, and
Hmm.
that also happened. I think the cut was more than 20-25%. It went on a intraday basis to as low as maybe 40, 35, 40%. What is your take? Gold we all heard, but a bit on silver as well. And gold and silver, you said that you cut down the position, you again added back. Did you add back the entire or did
Yeah.
you add back a partial? So a bit on gold and silver, your view.
So Monday we added back a partial. I'm always anybody who wants to understand about investing needs to read only one book, Reminiscence of a Stock Market Operator. This is about Jesse Livermore. And in that book, over 15, 20 years, I realized that whole numbers are the most important numbers actually, around which markets react. So you saw that what happened in gold, it went above 5,000, but it broke 5,000. Silver went above 100, again a whole number, but broke that thing. So we added partially. We are not confident at this point of time that correction is done, but I could be wrong also. We will add back to our complete position once gold closes above 5,000 and once silver closes above 100. My view over the gold and silver over the next 3-4 years is gold will be minimum 8 to 10,000 and silver will be between 2 to 3% of the value of gold. It could be higher, but it will not be lower. And let me put it over here that in German hyperinflation time, we are not entering hyperinflation anywhere in the world as of now. In German hyperinflation time also, gold went through the roof, but there were 4 or 5 times when the correction was as deep as 30 to 40%. Nobody made money. Only those people who made money were the ones who understand that Germany is going through hyperinflation. So do not try to trade this market. I'm very clear about it. Otherwise, it will go from 25 to $300 in a matter of 7, 8 years, and you would have only lost money if you trade this thing. You cannot trade this. For me, I am only a risk manager once the money has been made. So we cut down from 9.5% to 5%. We brought it back to 6% on gold. Once it crosses 5,000, we will go back to 10% on the value of 9 to 10% of the value. Whole number is very important. It has to break that number and stand over there for one day. Then I can very well say correction is done.
Got it. Great. Thanks, Ritesh. I